Welcome to The Explainer. Today, we are diving straight into the blueprints of what was essentially a financial doomsday machine. And the craziest part? It was meticulously built by literal Nobel laureates. We're going to explore how the absolute smartest guys in the room engineered a system so incredibly complex and so massive that its eventual failure threatened to take down the entire global economy. Okay, so let's just jump right into the climax of our story here. The date is Wednesday, September 23rd, 1998. Now, at this time, the American economy is seemingly in the salad days of this massive bull market. But on this specific afternoon, Wall Street is staring down the barrel of a $1 trillion systemic collapse. Yeah, that's a trillion with a T. Part 1. The trillion-dollar crisis. To really understand how this happened, we have to look at a highly secretive emergency meeting taking place at the Federal Reserve Bank of New York. The Fed actually summoned the heads of every major Wall Street bank. We're talking Bankers Trust, Bear Stearns, Chase Manhattan, Goldman Sachs, JP Morgan, Lehman Brothers, the whole shebang. These guys are fierce, bloodthirsty competitors, and the Fed was so unaccustomed to hosting such a massive group of titans all at once that they literally didn't have enough leather-back chairs for them. So you have these incredibly powerful CEOs squeezed elbow to elbow into folding metal chairs, and they were all brought together to bail out one single obscure hedge fund, long-term capital management. You can imagine the sheer panic anchoring that room. Long-term capital management, or LTCM for short, was on the brink of total failure. They had amassed this staggering $100 billion in assets, almost all of it borrowed. But it gets worse. They held derivative contracts covering an astronomical sum of more than $1 trillion. LTCM's tentacles were just so deeply intertwined with every single bank sitting in that room that if they defaulted, every bank would rush for the exits to escape their one-sided obligations. It would have absolutely triggered a worldwide panic. So, Part 2. The Quants Revolution. Let's back up a bit. Who actually built this massive financial weapon? Well, meet John Meriwether. He was this modest, unassuming kid who grew up in a Catholic neighborhood on the south side of Chicago. Meriwether found his way to Salomon Brothers in the 1970s, and honestly, he completely transformed bond trading. Before him, bond trading was, a pretty dull sport. But Meriwether brought something brand new to the table: absolute mathematical certainty. He realized you could model price behavior, and if you just had the capital to wait it out, the math would always win. And this brings us to a really fascinating culture clash. See, Wall Street at the time was famously loud, chaotic, and aggressive. It was full of what were essentially described as unscientific Neanderthals who just traded from their bellies based on gut instinct and rumors. Meriwether, though, he started filling his arbitrage group at Salomon with these quiet, arrogant, MIT and Harvard-educated academics. These quants, basically nerdy mathematicians, used computers to model how prices should behave in the future. They didn't scream on the trading floor, they built equations. Meriwether's ascent was insanely rapid. By the 1980s, his group was the most dominant force at Salomon Brothers, just raking in hundreds of millions of dollars. But then, in 1991, disaster struck. One of his traders, a guy named Paul Moser, submitted false bids to the U.S. Treasury. Now, Meriwether wasn't directly involved in the fraud, but he was caught in the fallout for not reporting it quickly enough to the authorities, and he was forced to resign. But a mind like his doesn't just stay sidelined for long. By 1993, he was already plotting a massive, highly ambitious comeback. Which leads us to Part 3, building the dream team. Meriwether wasn't just looking to build another trading desk. He wanted to create the ultimate financial machine, completely independent of Salomon Brothers. To pull this off, he assembled a roster with staggering, almost intimidating credentials. We're talking Robert Merton, a leading Harvard scholar in finance, and Myron Scholes, an absolute pioneer in options pricing. Both of these guys would actually go on to win the Nobel Prize. And incredibly, he even recruited David Mullins. Why is that a big deal? Because Mullins was literally the vice chairman of the Federal Reserve at the time. Just imagine the confidence it inspires when the very guy who used to regulate the banks is suddenly your business partner. Armed with a brain trust like that, Meriwether went on a massive fundraising roadshow. Now, full disclosure, the roadshow was actually incredibly awkward. The partners sounded exactly like the math professors they were. They couldn't really tell a compelling story, and they flat out refused to give exact examples of their specific trades. Yet, despite all of that, the sheer gravity of their intellect secured $1.25 billion. At the time, that was the largest startup capital ever raised for a fund, no question. They organize this massive pool of money as a hedge fund. If you're not familiar, as far as securities law is concerned, a hedge fund is essentially a private, largely unregulated investment pool exclusively for the incredibly wealthy. By limiting their investors to just a select few, hedge funds are totally free from the SEC rules that force typical mutual funds to diversify. This meant LTCM was completely unshackled. They were free to concentrate their portfolios and, crucially, borrow massive amounts of money to amplify their bets.
Part 4. The Arbitrage Machine.
So you're probably wondering, what were these academic geniuses actually doing with all that money? Well, their entire foundation was built on a concept called arbitrage. Here is the basic idea. In a perfectly rational world, two identical items should cost exactly the same. If they don't, you've got an opportunity. Arbitrage is simply buying the artificially cheap asset while simultaneously short-selling the related, artificially expensive one. You don't even care if the overall market goes up or down. You're just betting that the price gap between these two specific items will eventually close. Let's look at a concrete example. There's signature trade involving 30-year U.S. Treasury bonds. The Treasury constantly issues new bonds. The brand new ones are called on-the-run bonds. Investors absolutely love them because they are highly liquid, which makes them slightly more expensive. But a 30-year bond issued just 6 months ago? That's called an off-the-run bond. It's considered older, usually sits in a safe somewhere, and is far less liquid. Therefore, it trades at a slight discount. It's just a little bit cheaper.
So here is how they turned this into a master plan. Step 1, the LTCM computers would identify this exact price spread. Step 2, they short the expensive new bond. Step 3, they use that cash to buy the cheaper older bond. And step 4, they just wait. Because eventually, as time naturally passes, the new bond becomes an old bond, and their prices must mathematically, inevitably snap together. It's the magic of arbitrage. But here is the shocking truth about this supposedly massive opportunity. The spread between these bonds was incredibly, almost laughably tiny. In 1994, the gap was just 12 basis points. To put that into real everyday money, for every pair of $1,000 bonds they traded, their guaranteed profit was a meager $15.80. So the obvious question is, how on earth do you turn a $15 profit into a multi-billion-dollar empire? Part 5. The Power of Leverage.
Seriously, how does a tiny, almost invisible profit turn into a $1 trillion systemic threat? The answer is leverage. Think of leverage kind of like a seesaw that enables a child to raise a much greater weight than they ever could on their own. LTCM didn't just invest their $1.25 billion and call it a day. No, they used it as a tiny base to borrow 20 to 30 times that amount from the banks. They leveraged their capital at a massive ratio of 1 to 30. By borrowing billions of dollars, they could multiply that tiny $15 profit millions of times over. And they achieved this insane level of leverage through just supreme arrogance. Normally, right, when you borrow money to trade, the bank demands what's called a haircut, a percentage of collateral to protect themselves in case the trade goes south. But LTCM, they just refused to post standard haircuts. And because they had Nobel laureates on staff and a seemingly flawless track record, the banks literally let them trade without putting any extra money down. It was the equivalent of being handed the keys to a highly leveraged car and being told you can drive as far as you want without ever having to buy gas. Ultimately, the partners at LTCM truly believed they were doing the market a public service. They didn't see themselves as gamblers. They were scientists. They believed that whenever markets panicked and spreads temporarily widened, they were simply stepping in to provide much-needed liquidity. They thought of themselves as a giant insurance company, just collecting small fees for taking on slightly less liquid bonds, completely and safely insulated by their perfect mathematical models. But as we know from that tense, claustrophobic meeting at the Federal Reserve with all those billionaires sweating in folding chairs, the math wasn't perfect. LTCM completely forgot that markets aren't actually made of numbers. They're made of people. Which leaves us with a pretty terrifying question to ponder. If you build a trillion-dollar machine based entirely on the assumption of rational, perfect math, what happens when completely irrational, unpredictable human panic breaks the equation? Thank you so much for joining me on this explainer, and I'll leave you to think about that until next time.